Are you an investor with a large individual stock position or handful of individual stock positions, and you're concerned about diversification, but you don't want to get hit with a huge tax bill? This episode is for you. Welcome back to the Financial Symmetry Show, where we're passionate about helping you enhance today and enrich tomorrow. And today I'm joined by Mike Eklund. Mike is one of our financial advisors and also passionate about investment strategies. So he's going to talk to us about what are some of our options. If we're one of the lucky few who invested in NVIDIA 10 years ago, or maybe we were gifted or inherited stock from a family member and we want to liquidate it, maybe we have a reason to liquidate it, but the tax bill will be considerable. So we have concerns about that. And we want to think about what are the options? How do we limit those taxes?
Yeah, it's a good problem to have, Allison. Like the stock market has done very well the last 5 years. It's up over 70%. A number of individual positions, like you mentioned, a lot of technology companies are up much more. You may realize, you know what, I really need to diversify. I understand I don't want to own too much of one stock or one sector, but you don't want to pay the tax bill. I enjoy investing. I also enjoy saving money on taxes too. So we really want to talk today about some options that are now available that have become more common in the last 4 or 5 years to see if maybe they're a good fit for you.
Exactly. And we always want to think about these decisions in the context of your overall financial plan. We've mentioned in the past, we don't want to let the tax tail wag the investment dog, and we don't want to let the investment strategy drive the financial plan either. We really want to be thinking about what are your plans for the future? What are your goals? And then we can think about if these strategies might be the right fit for you. Now, there are some new things that are more available to, I want to say, retail or general investors than they have been in the past. So tell us about a few of those, what we might be able to consider that maybe were not available to ordinary investors or non-accredited investors.
No, that's a great point, Allison. Yes, a lot of these options today have not been available in the past because the technology wasn't available or there to offer to folks, as well as the minimums in terms of the amount of assets you had to have typically was reserved for ultra high net worth. So it might not have been a good fit for everyone. Now, the one thing I just want to mention before we kind of walk through some of these options that are now available is that most of the things we're talking about today are more tax deferral versus tax avoidance. So what I mean is tax deferral is kind of think about like your 401k. You put money in, maybe you save on taxes now, but down the road when you withdraw that money in retirement, you're going to pay taxes then. That's kind of the stuff we're going to talk about today. Tax avoidance is more like a deduction or a tax credit. Think about, let's say you make a charitable contribution. You get a tax deduction for that reduces your taxes today. It's not a tax deferral. So just keep that in mind. A lot of stuff we're talking about today is more kicking the can down the road. That may make sense for you, it may not. There's some benefit for not paying taxes today, but it's not that you're going to avoid never paying taxes in this situation.
Okay, so you're deferring the taxes and you're also diversifying the position, right? Because that's a huge risk if you have that individual stock position or just a handful of stock positions that they've done really, really well. They don't always tend to continue doing well in the next time period. So tell us more about the risk of, why don't I just hold on to it and I'll sell it in 10 years when I retire, my tax bracket's lower.
The majority of stocks, not the majority, it's really over 90% of stocks underperform the market over the long term. The time period will depend on what statistic you use, but that is a big risk to your financial plan. If you're assuming to retire in 5 or 10 years and you want to spend X dollars per year, that decision is highly dependent on how the investments perform. And if you have an investment that, for example, I worked at a company where their stock went from $50 to 50 cents, that is going to make a big difference into your financial plan. The folks that worked at Enron or Lehman Brothers, where the company went bankrupt, there's nothing left. So these strategies, a lot of them we're talking about today, would help diversify that risk, where, maybe you're going to end up paying taxes later, but you're also having less risk in your portfolio.
Those are great examples because an individual company can create incredible wealth. It can also destroy it just as quickly. So we want to make sure that we're keeping those financial plans intact.
So we have 4 things we want to talk about today. The first thing I'll just mention is I like to, and anyone who listens to me in the past knows I like to use the word shiny objects. Sometimes, especially if you listen to influencers online, they'll try to sell these options that everyone should be using them. I like to say shiny objects because a lot of times, majority of the time, it's not right for anyone. Very unique cases. It could be right for you. And we just wanted to mention these are options available today. But just keep in mind, there are pros and cons to each of them. And what we're going to walk through are the four ones are something called exchange funds. This would be interesting if you have a large individual stock position. Something called a Section 351 exchange. This is more of a diversified portfolio you're looking to change. The third one is called a separately managed account. And then the fourth item, a little bit newer product today called a tax-aware long-short strategy. So finally, I just want to mention, obviously, this is educational only and not a recommendation for your individual portfolio. Obviously, if you're working with financial symmetry, we recommend reaching out to your advisor to learn more. But just learning more, this is just more of an educational discussion on the options today.
Great. And these are all, as you mentioned, tax deferral strategies, not tax avoidance strategies. If you really want to avoid the tax, then maybe we're thinking about some things like you mentioned earlier, donation, or gifting the stock to other family members who may be in a lower tax bracket, or maybe you have some business losses that you could sell the stock and you offset with some business losses, pay a lower tax rate. So there might be some options like that you consider if one of these isn't the right fit. We can talk through those on another episode or in the context of your plan as well. So tell us a little bit more about those exchange funds.
Yeah, so this is the first one on the list. So, vision that you maybe bought NVIDIA 10 years ago. The stock has done extremely well. You have $1 million unrealized gain, obviously a good problem to have. One option is you could sell it, you pay the taxes and reinvest it. And a lot of people, this one concern is they don't want to pay the taxes at that point. But there's something called an exchange fund where not only yourself, but other investors, multiple investors contribute their individual stocks. So you might have NVIDIA, they might have Apple, someone else might have Procter & Gamble. So there's different companies going into this new pool of investments. Then it's a new investment structure called an exchange fund. Some of the details regarding it is you have to hold the fund for 7 years. You really can't get access to your money. So there is some liquidity concerns. So this is really only an available option for folks that have liquidity and don't need the money for at least 7 years. And then after those 7 years are done, you'll actually receive not only NVIDIA, but likely 20 to 30 other stocks back. So you keep your same cost basis. So let's just say you paid $100,000 for NVIDIA initially. In 7 years from now, you'll get that stock back plus the 20 or 30 other stocks as well. And so that allows some diversification. It allows some potential return. You're not taking the risk all in one company. Now, the downside is you also own the cost of these investments are a little bit more expensive than you would if you owned a regular ETF or mutual fund. It is a partnership, so it actually is what's called a K-1s for those that don't like delaying their taxes. Well, sorry, you're going to have to extend your tax return. In addition, the exchange fund is required by law to own about 20% in real estate. So if you're not a big fan of owning rental real estate as an investment, that's probably not a good fit for you. And then finally, like I mentioned before, this is not a tax avoidance, it's a tax deferral strategy. So after 7 years, you get your new basket of companies back, but you still have the same cost basis. If you sold all the companies at that point, you'd pay the taxes then. The other option, to Allison's point, in the future, you could gift that stock away. Unfortunately, if you do pass away in the future, which at some point everyone will, that stock gets a step up in basis. But it's a way to help diversify that risk of owning that one company that technically could go bankrupt at any time.
That's an interesting point. So if someone passed away in that 7 years, would their heirs get the step up in basis to the new value? I'm thinking about that now. I don't think we know that yet. Do we?
That's a great question. Now, I know what happens before you gift it. I know what happens after. I believe you do get a step up because every month you get a new value of the new investment. But technically you get, I would not be, your plan should not be, passing away and gifting the stuff. At least I would not plan on that, but
it happens to all of us, right? Now, is there a minimum amount of a stock we have to have? Did you mention that already?
I did not. Now this is where technology has really improved. So there typically was only a couple providers that provide this option to investors, and it was very expensive. The minimums were very high. Now there are some new providers using some, obviously with technology, able to provide this at a lower cost also, but still requiring somewhere between 250 to 500,000 of that individual stock to be donated. So it's something to consider. some of the, in some situations, it may make sense just to sell it. And there's some calculators that we have that we can evaluate for you saying, if we just sold that stock and we reinvested the proceeds, what are you better off? Because of the higher cost, because of the real estate component, that new fund you're going to be invested in will likely have lower returns over the next 7 years than just investing in, for example, the S&P 500 index fund. But it's reducing that risk of that individual company.
That was something that you mentioned as well, as you're mixing with other investors who are putting their companies in, which if they're all companies that have done extremely well over the past 5 to 10 years, they could be sort of sector specific, right? It's possible that they all could be from that same sector, increasing risk as well. So could be concentration risk, not as great, but still not insignificant.
No, that's a great point, Allison. And that's why if you do go this route, most exchange funds today allow you to peek under the portfolio before you start. So you can commit to it, see what the actual holdings will be. And like you said, if you're trying to move away from a lot of technology exposure, you could see, well, if the portfolio is just all technology, maybe that's not the right fit for you. Maybe looking at those other options that either we'll discuss today or just as we mentioned, either gifting it or selling the stock anyways.
And if I were interested in this, do I need to be an accredited investor? Are there any other requirements that people need to meet?
Yeah, typically it's at a minimum accredited investor. An accredited investor, for those listening, is typically, I believe, $1 million of net worth. For certain funds, that is, you actually need to be a qualified purchaser, which is actually $5 million of investable funds. So yes, if you have a $50,000 gain and you're thinking of this is probably not the right fit, we're talking about kind of a significant, $500,000, $1 million type holding, plus that you're looking to diversify as you understand the risk of owning, one stock.
And thinking about this, so this could be a great fit for someone who's 7 to 10 years away from retirement, and they could realize that gain when their tax bracket drops, potentially. But also want to keep in mind, are you sending kids to college during that time frame? Are you planning a major home renovation? Are there reasons that you might need access to additional funds? And this might mean you have that money tied up and you're not able to access it. So something we really want to think about before you dive in head first to one of these options.
I'll be honest, as an advisor, I've looked at this with multiple clients, and I've done it before, but very infrequently. It's one of those things that's the majority of the time it doesn't make sense. But this is just an example we wanted to mention that it's worth considering if your situation would be, as Allison mentioned, you don't need the funds, the gain is large enough, and you qualify as a certain type of investor.
And as you mentioned, it does add some additional complexity to your tax return. And as we see, get ready for extensions, get ready for a potential letter from the IRS. So if you're not somebody who likes kind of dealing with the details and getting in the weeds on that, might be something to consider there. Okay, so tell us more about what our other options are in addition to the exchange funds.
Yeah, so the next one is called a Section 351 fund. So a lot of numbers here, but think about what we just talked about. But let's just say you own multiple stocks, or let's just say you own an exchange traded fund. You don't want to own anymore. It's just like I mentioned before. It's a technology focused fund, and you're like, I want to move away from technology and I want to just own the US stock market. Think about if those are familiar with something called a 1031 exchange for real estate. It's an option to do for non-real estate stocks or ETF type investments. This would be in a brokerage account, because keep in mind, if you're in a retirement account, you can sell the holding without paying a tax in that situation. But so this is another example where technology has really changed the game, in that up to a couple of years ago, this was something that was in the IRS tax code, but no one actually did because it was so much work. But this is, for example, before we mentioned you had that one stock and you made $1 million on it, NVIDIA. Let's say you own 7 stocks and you made, $1 million in total, but they're all the same amount. This is a situation where the exchange fund, your individual holdings probably were too little, but this situation will allow you to gift those 7 stocks to what's called the 351 fund. And then now you'd own a new ETF and allow you to then, whatever that ETF strategy is, to sell it or hold it as well.
So that's another option there. If we didn't all have the foresight of, was it Peter Thiel that had the PayPal inside his Roth IRA?
I believe he did.
Yeah. So that would be, if you know that this stock is going to go to the moon, you just go ahead and put it inside your Roth IRA. If you have one of those set up, and you avoid all these headaches. But it's good news that we do have some options.
Yeah. And once again, this is deferral, not tax avoidance. This is deferral. The benefit of this one versus the exchange fund is technically when that money goes in ETF, you could actually sell it the next day into the new ETF. It's not like a K1 where you have to extend your tax return. The negative is if you're going to do this, you're probably not going to sell the stock the next day because you're going to, why would you do this and then pay the taxes? You're really doing this because you don't like the way the holdings either not diversified or they're in a certain area of the market you don't agree with. And the typical funds we would recommend in a situation are, for example, a U.S. total stock market fund, index fund. So it would just track the U.S. total stock market, and you'd get the returns that would be generated in that market.
And then you're very broadly, much more broadly diversified than just those handful of companies. So that's really good. And we're talking about stock positions, and up to this point, we've been talking about publicly traded. And I'm assuming all these options are only available with a publicly traded security. So not a small business that you're an investor in, a private investment. These are not options if that's where your wealth is tied up.
That's 100% correct. Yeah. So if it's traded on the U.S. stock market exchange, at New York or NASDAQ, this is an option for it. If it's a private investment, like you own a business, like we're owners of Financial Symmetry, that is not an option today for these type of choices.
Okay. So we got to look at other options if that's our situation.
Yes.
All right. Sounds good. So what else do we have?
So that's the Section 351. Like I said, there's some benefits to it. It's a little bit more flexibility, but once again, you're just deferring those taxes to a later date. The next one up actually is something that's been around a little bit longer, called a separately managed account. So this is a situation where, you think about if you want to own the S&P 500 index fund, you could go buy a mutual fund or an ETF, and that's like a basket that owns all of the 500 companies individually. Or there's actually an option where you could actually, invest in a separately managed account where the investment manager will buy those 500 companies directly. So instead of your brokerage statement saying, here's S&P 500 index fund, you're going to get a statement with all 500 companies listed individually. So some like that, some are a little don't want all that complication. So why would someone do that? Because, why would you own 500 versus owning one? I think for some folks that want, like we mentioned before with technology, they want to remove certain sectors or certain companies from their portfolio. Maybe they work at a company like we mentioned NVIDIA or Amazon, and they don't want to own that in their portfolio given their exposure. This would allow them to only own certain companies or sectors as part of their holdings versus typically with an ETF or mutual fund, you're forced to own whatever the manager selects to.
Exactly. So it could be an opportunity too, if you're someone who is interested in excluding particular companies for a certain reason, whether those are environmental, personal, religious, those separately managed accounts are something you could consider as well if you want to exclude particular companies that you find to be bad actors for one reason or another. Yeah. Not something we might always recommend, but something to consider.
Yeah, and I think the more popular use case today is what's called tax loss harvesting. We can include a blog. I know Allison and Chad did a blog a while back on this, our podcast, kind of explaining it. But the reality is somewhere around 35% of individual companies are down every year. So this allows you to sell one holding and buy another and realize that tax loss. Where if you own the individual ETF or mutual fund, if that fund is not down, then you don't have the same opportunity to realize that loss. Now, it's not as good as it sounds, just because there are some negatives of that. Is down the road is if you keep doing that, you're just deferring the taxes once again. And then the other thing that's an issue, 5-10 years from now, is it's really hard for the manager to rebalance because every time they want to sell one stock and buy another, they're going to have to incur taxes. So once again, it's maybe saving you a few dollars in taxes today, but the end result is you might pay more taxes in the future. So once again, it's more of a case-by-case situation.
Yes, and those tax bills are really going to change based on what's happening in your life. Whether you're in your highest earning years, you're going towards retirement, maybe you're in your later retirement years, you're shifting into an assisted living facility, and some of those costs are tax deductible. So we really want to bring it back and look at that accumulated stock position where you have that concentration risk in the context of that overall financial plan and everything else that's happening in your goals in your life to find out if one of these are a good option for you or if there's another strategy that might be the right fit.
Yeah, and as you mentioned, Elle, it always goes back to your plan. So once again, as we mentioned, this is educational purposes only, and we'd want to evaluate if it's a good fit to you. Because in this situation, for example, some people don't want to look at a account statement that has 500 stocks. They don't want to see a 1099 at the end of the year that is 100 pages because it's all the individual holdings that were bought and sold. So adding a lot more complexity for folks when we think a lot of times simplicity is a lot more better outcome for most folks.
Yeah, you might want to ask your CPA or your tax preparer first if they're okay with you moving forward with this, or if they're going to tell you, you're going to need to use TurboTax to prepare your own return next year. I'm out. Okay, so we have one more here, the tax-aware long-short strategies. So that's a mouthful. I'm guessing it's as complex as it sounds.
Yeah, this I would say is the shiny object of the day.
Okay.
So this is definitely something over the last year has gotten a lot of traction. It is a very complicated approach, similar to the last strategy. We talked about the separately managed account. It's using that strategy, but then also having what's called a long short overlay on top. So what's happening is they're investing your money, the $1 million, and then the manager is also you're borrowing, let's just say an additional 300,000. So a lot of people are adverse to leverage. So now you're putting margin on your portfolio. And then the investment manager at that point is then taking the extra 300,000 and buying 300,000 stocks and then shorting 300,000 stocks at the same time. So technically they're what's called market neutral. They're not long or short. What this is doing, and it was very complicated, it's giving them more opportunities to realize losses. So it's adding complexity, it's adding cost because the manager now is going to want to get paid more for that extra amount of money that they're managing. You have to pay the cost to borrow money. There's what's called margin. That's expensive as well. But it's gaining traction because it allows investors to realize more losses in year one and year two. Because in the previous strategies, for example, the separately managed account, it depended on how the market did that year, where this approach, the market could be doing well or doing poorly. There's always typically opportunities to realize losses. So why is this not perfect or why people don't jumping to do this? Because one, it's more expensive. Number two is you're going to have what's called tracking error. It's going to do better or worse than the index. So if you want to just invest in the S&P 500 and that did 10%, you may do 5% or you might do 15%. A lot of people don't like that kind of variance of what could happen. Also, it's a lot harder to get out of. So once again, it's tax deferral, not tax avoidance. So down the road, if you're just like, you know what, this is too complicated, I don't want to do this anymore. You try to sell and just move to something else, you're going to pay a big tax bill that year. So a lot of these things create a lot of complication. They sound really good day one, but the reality is they just create more problems down the road.
Interesting. So it sounds like it's very specific use cases where we would want to advise these for an investor. And I heard something this morning, which you reminded me of it at the beginning, that there's a lot of voices out there. There's a lot of YouTube videos. There's a lot of podcasts just like ours, but where people are advising certain strategies. And as you said, shiny object of the day, making them sound very, very good. What I heard this morning was loud voices, small portfolios. So they might not always be in your best financial interest just because they sound great might not be the best case for you. So we'd always advise you to come back to your financial plan. What are your goals? What's happening in your family, in your life? And what are the best strategies to support those over the long term? And then if one of these is the right fit, then great, we can plug that in and make it work for you. And if not, we can come up with another solution that will hopefully fit your life even better.
No, I think that was well said, Alice. And I think once again, just go back to, simplicity matters. And end of the day, all these things sound great, but what might make the most sense if you have these situations, which is a good problem. You have an investment that did very well. I mean, or you sold a business and you made a big capital gain. That's a good problem to have. You're paying taxes for a reason, but sometimes just the boring selling the appreciated investments, paying the taxes and reinvesting for the long term. I know it sounds boring. No one likes paying more taxes, but that may be the best fit. And that's where a fee-only advisor like Financial Symmetry can evaluate those options and figure out what's the best fit for your situation.
Exactly. And as we said, sometimes you bought a stock that's highly appreciated. Sometimes you inherited it or were gifted it. And sometimes we can feel a little stuck when we're sitting on something and we don't know quite what to do. And we've just listened to several very complex options here on our podcast. So having an accountability partner and somebody who can walk you through what might be a good fit for your situation can be very beneficial. So we are happy to help. We have a wealth of blogs and podcasts on our website on a variety of topics. You can visit us at financialsymmetry.com and click the Talk to an Advisor button there to set up an appointment with one of our advisors.